சரி இந்த ஃபார்ம் சார் அது ஒரு ஃபார்ம்
கொடுப்பாங்க சார்.
Sir, am I audible?
Yes, you're audible.
Good afternoon, sir.
Hello, madam. Good afternoon to you. Namaskar.
Thank you, sir.
Sir, good afternoon, sir. You can wait for
Sir.
good
Namaskar.
afternoon, sir. Yes.
Vanakkam.
Welcome, sir. Thank you. And we can wait for another 3 to 4 minutes, sir.
Sorry?
We can wait for another 2 to 3 minutes.
Yeah,
sir.
that's fine, sir. Fine, sir. That's fine.
Satsriakal, sir. Can you hear me?
Yes, ma'am.
Sir, I was talking to sir.
Oh,
I Ganapati, sir? Sir, can we start the session at sharp 2?
ma'am, we can wait for another 2 to 3 minutes, ma'am.
Okay, okay, sir. Thank you.
Good afternoon, madam. Namaskar.
Sir, good afternoon. Satsriakal, sir. I don't know whether I'm pronouncing it right. So how should we say it, sir?
Yeah, madam, I am absolutely ready. I'll start whenever you ask me to start. That's fine.
Okay, okay. Sir, I was asking how to pronounce the phrase Satsriakal.
Okay. So, it means, let me just explain the meaning. Sat is truth, as we know, right? Shri is kind of respect, and Akal means almighty, one who never dies. Akal, right? So Sat Shri, Sat Sri in Punjabi, actually we don't say Shri, we say Sri. So the H is missing, so to say, right? In Hindi we will say Shri, but in Punjabi we normally say Satsriakal. Although, yeah, so Satsriakal. That's right.
Thank you.
Welcome.
Okay, we can start, ma'am, because we are almost 2 o'clock. We can start the session.
Okay. A happy and marvelous afternoon to one and all present here. On behalf of our institution, SA College of Arts and Science, I extend my warm welcome to our Honorable Resource Person, respected Principal, beloved Director, faculty members, and colleagues to Day 3 of the 7-day online faculty development program on Cognitive Analysis in Financial Services, organized by Internal Quality Assurance Cell, IQAC, in association with the School of Commerce and Management, SA College of Arts and Science. Sometimes the most ordinary things could be made extraordinary simply by doing them with the right people, says Nicholas Sparks. And we are fortunate to have the right person here today with us, our facilitator, Mr. Ravinder Singh Chawla, founder and managing partner, RSC Skill Building and Consulting Solution LLP, who take extraordinary efforts to teach and delight the participants. Sir made yesterday's session on investment management, equity markets, a fruitful and interactive one. And today, we're going to have yet another fruitful session on the same topic. And I welcome you all. And participants, please cooperate with us. Kindly stay with us till the end of the session and answer the quiz before 5 p.m. And now, with immense pleasure and honor, I would like to invite our esteemed guest speaker, Mr. Ravinder Singh Chawla, to take over the session and address the virtual gathering. Sir, over to you. Thank you.
Thank you very much, madam. Good afternoon to all of you. It's indeed a pleasure for me, in fact, a privilege to be here with you all on day three of the faculty development program. Somebody has sent me a direct message asking to explain the difference between large cap, mid cap, and small cap. We shall again discuss this when we shall be learning about mutual funds, right? So kindly bear with me. Else, what we'll do is that on Monday, hopefully on Monday we will have some 15-20 minutes extra with us. So we shall discuss it at that time, if it is okay with you, right? Because today's session is going to be a packed one. And in fact, I may request you, that we may have to extend it by 15 minutes because we are going to be learning a lot of things today. And I don't want to rush with the things at the cost of difficulty, because today's session is going to be a little complicated. But I'll try to make it very easy to understand. Hopefully, I should be able to do that. So request your support. We shall not be able to discuss doubts today pertaining to the last session. We shall again discuss it on Monday or on Tuesday when we shall learn about mutual funds. All right. So let's start with the scores. Okay. So the Excel sheet is there in front of you. So these scores pertain to those participants who have cumulatively for the first day and second day scored full marks.
Participants, please mute yourself.
So these are the
inconvenience, sir. You can proceed now.
So these are the scores. So there are, as you could see, there are some 13 odd participants who scored full marks. So heartiest congratulations to all of you. It's quite possible that in case there are some more people who think that they have also scored full marks in the first attempt itself, you may kindly let me know. You may send a message to me on mobile. I'll have it checked out. Because it's quite possible that somebody's name may have been different. For example, earlier it may have been email ID, and that may have caused some confusion. So please bear with me. But to the best of my knowledge, this is what the cumulative scores are. Okay, so let me now share the presentation. All right. So we are going to learn about investment management equity part 2. Now, let's quickly discuss about the learning objectives today. So we shall first learn about the comparison between technical analysis and fundamental analysis. Right? We shall then learn about very important thing. Yesterday, we learned about, with the example of Rajat, we said that he is opening a restaurant. And we said that his restaurant is doing a flourishing business. He is earning a lot of profits, right? So today we shall attempt to see as to how do we compute profit, because that would then help us to understand the financial ratios in a better manner, right? Okay, one thing important, how many of you here in this particular session, they are not from a commerce background? So how many participants, they could be from arts background or a science background, which means a non-commerce background? If there are any HODs, if they could kindly help me know. How many people are from a non-commerce background? Because that would, give me an idea as to how much time should I be spending on explaining the concepts pertaining to books of accounting. Okay, so one participant has mentioned. All right, all right. So others have not mentioned. So is it that they are from the commerce background? Dr. Ganapati sir, in case you have some idea, if you could kindly help me know.
Sorry, sir. Actually, the participants are from different colleges.
Okay, all right.
They
No
are
issues.
not alone from SA institution. They are from different institutions. So
All right, no issues. So I'll presume that they are from a non-commerce background. I'll presume that, and I'll proceed according. All right. We shall then learn about the financial ratios, right? And then very importantly, the concept of valuations. So what is it that we keep in mind while evaluating whether a particular stock could be priced correctly or it could be underpriced, right? And then very importantly, we shall learn about the concept of moat. What is a moat, and what could be the different kinds of moats for different organizations. Okay, so great. Let's get going. And as always, looking forward to your participation. Now, yesterday we discussed about Wipro, right? And we discussed as to how much has that stock created wealth for the companies. Today we shall learn about Infosys. Just quickly speaking, we'll not spend too much of time on this. So if somebody had bought 100 shares of Wipro at the time of I beg your pardon, Infosys, at the time of IPO of Infosys, right? Then by 2020, this person would have had, as you could see, 1 crore 39 lakhs 36,000. No, sorry, I beg your pardon. It's 13 crores 93 lakhs 66,400. Right? That's the kind of wealth creation which happens in the stock market. Right? And obviously, this person would have remained invested since 1994. Okay. Now, why is there a huge potential, and why is your role so important? See, the fact of the matter is that we are actually, in a situation where there is tremendous scope for growth, right? In India, as you could see, just, around 4% of the population, they invest in the stock market, just around 4%. Whereas if you see in US, 55% of the population invests in the stock market. China also, their number is 3 times more than us, right? More than 3 times of us. And that is where we need to really be able to make a difference by supporting our students, get knowledge about it by sharing these, these concepts of financial literacy with them, and encouraging them to start investing, right? Because let's accept it, somebody like me also started investing only from the age of 35. And I'm sure there would be many faculty members here who may have started investing quite late, right? But then just like, every teacher and every parent, they try to do, they would try to share with their children what they did not get from their parents and teachers, right? So that is what we need to do, very important. Another success story, Motilal Oswal company, I'm sure you would have heard the name, the co-founder of Motilal Oswal, Mr. Ramdev Agarwal, right? How he was able to generate wealth from 1 crore rupees to 2,200 crore rupees in 31 years, right? So he did lose money, he lost money, but then he remained persisted, he kept investing regularly, and that's what is the secret. All right, let us now learn about what is fundamental analysis, just briefly, and then we shall learn about technical analysis, and then we'll try and compare. Okay, anyone, if you know about little bit about fundamental analysis, what comes to your mind? What do you think is fundamental analysis? Fantastic. Security intrinsic value by examining factors related to economy and finance. Bingo, absolutely right, Poonamallee madam. As always, well done. Superb, right? Fantastic. I mean, let me give an example to you. Let's say you are going to a food shop, right? Now, there could be two ways of ordering food. One way is that you call up your, fruit vendor and you ask him to give you apples. Now, you are relying on the fruit vendor to give you good quality apples, right? So that is like indirect investing when we invest through mutual funds. So we rely on the fund manager to do investment for us. The other approach is you doing investment yourself, right? Now, let's say you go to this fruit vendor to buy apples. Now, how will you choose apples? Maybe you will pick up the apple. You will look at, how maybe juicy it looks like, right? If the thick is, you may try and make some sound by knocking on the apple, and it gives you a good sound. It gives you a message that the apple may be juicy. You look at the color, right? You look whether there are any marks or not, right? So accordingly, you will take a call, right? Then you will also check the price. Now, the apple vendor would have different stacks of apples. Maybe one is priced at 220 rupees. So one is priced at 200 rupees. One could be priced at, let's say, 180 rupees, right? Depending upon the quality, correct? So you will now want to see whether the one which the vendor is quoting at 220 rupees, whether it is actually worth 220 rupees or not, right? Suppose you say that no, this apple is not worth 220 rupees. You will not buy it. But if you think that maybe it's even worth more than 220 rupees, then you will definitely buy it, right? So it is, as Poonamallee madam said, you look at the intrinsic worth of a particular stock or security, right? So every stock has a certain value. You try to evaluate it, whether the value, that it is quoting at, the price it is quoting at is in line with the value or is it not? Simple, right? Which means you are trying to assess whether it is of the right price, available at the right price or not, whether the quality is right or not, right? I'm sure you would have been buying, different stuff. You go to a jeweler, for example, you look at the design, right? Then you also check out the making charges. Then you work out whether the making charges are in line with the design or not. And then you take a decision, isn't it? Yeah, that is what fundamental analysis. So here you look at both qualitative factors as well as quantitative factors, right? So we shall check it out in the subsequent slide. Okay. Technical analysis pertains more to charts, patterns, right? In terms of what has been, the movement like, and then you predict. For example, when we watch cricket match, maybe IPL match, many times they show the prediction. Who's likely to win? Whether Chennai Super Kings is likely to win or whether Mumbai Indians is likely to win this match, right? So they would evaluate the past patterns, right? And that is how they work out who is likely to win the match. So it's more of a predictive analysis, right? Basis the past movements of charts, etc. Okay, so it's based on trend. What's the trend like? If the trend is upwards, right, then probably the trend is likely to continue. If the trend is going down, continuously down, then it may likely to continue going down, right? So then they evaluate, they try to predict the stock price using this using this trend. Okay, so it's based on certain data. For example, let's say the stock price is going down, right? And more people are selling their stocks, right? Now, since more and more people are selling their stocks as compared to last few days, more people have now started selling their stock. It means that there is a downward momentum, right? But imagine more and more people are buying the stock, then the trend would be upwards. Okay, so it, it involves analysis of price and volume charts. So at certain price, how many people are selling the stock, and at certain price, how many people are buying the stock, right? So then they analyze it and they work it out as to whether this particular stock would go upwards. If it would go upwards, what level it would go up to, right? And then many times you will hear the terms that, for example, this stock has resistance. The stock has resistance at this level, which means that, let's say currently it is trading at 300 rupees. So they will say that it has resistance at 305 rupees, which means the chances are it will not go above 305, right? But let's say if a stock price is going down, right? They may say that it has support at 290. Support at 290, which means that the chances are that if it goes down to 290, then more and more people would be willing to buy the stock, right? So it has support. So they work out support level, resistance levels, etc., etc. So it involves that kind of analysis, right? In fact, just to share with you, I have also been doing sessions on equity markets for colleges, including the technical analysis platforms also. And these are for students, and I've seen that a lot of today's students are really interested in earning short-term profits through trading also. So these are done in colleges. In case any of you is keen to get it done, these are free of cost, right? So these are done under the financial literacy campaigns. These are free of cost for the colleges as well as for the students, right? My professional fees is paid by the sponsoring agency. So this is done to promote financial literacy. So you may send me a message in case you are interested. Right? Now, in technical analysis, the horizon is short term. So this is from a trading perspective. Right? So let's now compare the difference between fundamental analysis and technical analysis. Right? What's the difference? So first of all, the fundamental analysis pertains to assessing the financial strength of a company, right? The growth of sales and the earning probability. So for example, how are the profits of a company? If the company has been earning profits regularly and the profits are growing at a rapid pace, the quality of the management is also good, right? Then more and more companies would want to buy this, more and more people would want to buy this stock. Isn't it? Just imagine your college has a great faculty. You are the principal, your college has got great faculty, great team, right? And the results of your college are really good. You are also able to invite reputed companies to conduct campus interviews in your college. The students of your college, they get placed easily, right? So obviously more and more students would want to apply to your college, isn't it? Technical analysis is more in terms of assessment of historical, past prices, price volume charts, the patterns, etc., etc., to work out as to what could be the stock movement like, right? What's the trend like? What could be the stock movement be like? Okay. So here in fundamental analysis, you try to find out the intrinsic worth of a stock, right? I am sure many of you may have gone to, let's say you go to buy a Kanjivaram sari, right? Now the shopkeeper says that this sari is worth 15,000 rupees. Now you are an expert, and because you are an expert, you touch the sari and you look at the sari and you make out, no, it's not worth 15,000 rupees, right? Example. So you say, no, it's not worth 15,000 rupees. Maybe somebody else, you look at some other sari and the price of that sari may be 25,000 rupees, and you say, wow, this is worth, this price, because actually this should have been 28,000 rupees or 30,000 rupees, right? So, well, by the way, I don't know anything about saris. I am just giving an example. So I don't know anything about the prices and all that. So please pardon me in case, Kanjivaram saris are much more expensive than the example which I gave. Okay. So fundamental analysis is more of prediction in terms of the trends, etc. Right? Fundamental analysts, they believe that the demand for stocks or the shares of certain companies would depend upon the underlying factors, like what rate the company has been growing at, what are the products of the company, how much are the products in demand, right? All these things. Whereas the technical analysts, they believe that they can forecast the supply and the demand factors, right? Just like look at the meteorological department, Indian Meteorological Department, IMD. So they make a prediction. They make a prediction that the monsoon would hit Tamil Nadu by let's say this date, right? So and they predict that this year the monsoon will be good, right? So obviously that's from a short-term perspective, isn't it? So that is what technical analysts do. Okay. So let's take an example. Let us say a particular stock. Let's take the example of ITC, right? ITC stock. Now, unfortunately, ITC has been trading at a certain range between 210 and 215 for a very long time. Now, let's say the analysts believe that if it crosses 220, then it will go up to 260, right? So they may believe that 220 is a resistance level, but if it crosses 210, then it will not have any stoppage till 260, right? That is what technical analysts. So let's just give me just 1 minute. Sorry. All right. Now, as we discussed that fundamental analysis is both about the qualitative and quantitative, right? Qualitative and quantitative. So let us look at the qualitative factors, right? Okay, so you tell me what could qualitative factors pertain? What could qualitative factors be like? Yes, please. Okay, nature or standard of something rather than to its quantitative. Yes, agreed. But give me some examples, please. Reputation. Yes, madam. Absolutely right. Matilda, madam. Type of management. Yes, Yusuf sir. Perfectly right. Right. The quality of management, the quality of its board of directors. Correct. The culture of the company. Right. Just look at your college, for example. Your college is a reputed college. Why is it a reputed college? Because the trustees are reputed people. They are very ethical people. The college has a legacy, right? A lot of VIPs, they graduated from your college, right? Your college has got great infrastructure, blah, 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 blah. Right? So these are the qualitative factors. Corporate governance, right? For example, the company is an ethical company. So look at certain, Infosys, Wipro, HDFC Limited, right? These are known to be very ethical groups. I'm just taking 2-3 names. That does not mean that it is restricted only to 2-3 names. There are many companies, right? Okay. The legacy factors in terms of reputation. What has been the history of the company? How much has it helped people create wealth, right? Efficiency of the management. How efficient is the management? For example, in case of college, how keen is the management in conducting various kinds of activities for the students? How regular are they in terms of organizing seminars, right? How much interest do they take in terms of co-curricular activities? All those things. I'm attempting to give you examples pertaining to your profession. I mean that's so that we could relate to this particular thing. Again, business model of the company and its competitive advantage, right? So let's say the company has some unique competitive advantage, right? We will talk about it again when we discuss moats, right? So obviously, let's look at DMart, right? DMart, Avenue Supermart. Now, DMart has been able to build a reputation that it runs stores where things are available at very competitive prices, right? So they are able to get a lot of volumes. They are able to negotiate with the vendors to reduce the prices, and they pass on those prices to the customers. So they have been able to build a reputation for that, right? Maruti is known for building very good cars. People have trust on Maruti, right? Again, the brand equity, how strong is the brand name of the particular company? How likely are the people, go to buy the products of that company again and again? What is the kind of corporate culture the company has? What do employees say about that company? What do customers say about that company? Right? Imagine a situation, a particular company has a very bad reputation in terms of bad customer service, right? So obviously, the quality will not be considered to be good, right? Okay, let's now look at the quantitative factors, right? So tell me what kind of quantitative factors could be. I would request everyone else to also participate. I am experiencing that there are only 8-10 people who are regularly participating. Others are not participating at all. Requesting everyone to participate, please. Fantastic, sir. Yusuf, sir, very right. Return on investment, return on assets, earning per share, right? Fantastic. All these things. Super. So let's look at it in detail. Okay. So this would pertain to the performance, quantitative factors, numbers. Right? So profitability of the company, right? Performance related. Again, the financial strength of the company in terms of its balance sheet. How strong is the balance sheet of the company? Right? Cash flows. A particular a particular company which is doing its business mostly in cash, right? So the company is a cash-rich company. Obviously, the investors would prefer that company. Right? Financial ratios of the company. So what are the various kinds of financial ratios it has? We will discuss about it in detail, right? Liquidity ratios, growth ratios, valuation ratios, efficiency ratios, etc., etc. Right? Again, the valuations. What price is it available at? Right? For example, it's a great stock, no doubt about it, but then it's expensive. Right? Like I gave you the example of Kanchivaram sari. Right? It's a great sari. It's a very good sari. There's no doubt about the quality, but you feel that it is expensive. Right? So you will not buy it. If you think that the price which is being charged for it is beyond what it should be quoted for, you will not buy it. All right, so this is a repeat thing what we learned yesterday, and there's a reason why I'm talking about it. So as we know, we need to consider risks, returns, and liquidity. Right? All right. Could there be possibility that certain stocks may not have very high liquidity? Certain stocks may not, you may not be able to sell them as frequently as you may be able to sell other stocks. Could it be possible? Yeah. So could certain stocks have lesser liquidity? So give me an example, sir. What could be the situation? Yeah. So property, I'm talking about stocks. So let's look at it. Say, for example, there are certain penny stocks. Penny stocks mean they will be available at price of maybe 1 rupee or maybe even less than that, 2 rupees, 3 rupees, right? There are not many people who want to buy this stock, right? There are many people who are willing to sell this stock, right? That is the reason the stock price is not rising. Now, in that case, you may not be able to sell off that stock, because for you to be able to sell off, somebody has to be willing to buy. No? But imagine a situation when there are only sellers in a particular stock. There are not many buyers, right? So then the liquidity would be low. Okay. It could be some unlisted companies, right? So obviously, because it is not a listed company, it is not getting bought and sold regularly. So then the liquidity will be low, right? Again, imagine that a particular company, let's say Rajat's example, just a minute, let's look at the same example which we were discussing yesterday, Rajat's restaurant, right? Now let's say Rajat is looking for a partner. Imagine Rajat requires more capital. He is looking at one more partner to come and invest money in the company, right? Now imagine if Rajat, Rajat wants a partner, but he may not be able to find a partner. Possible, right? Real estate, as we all know, the liquidity is low in real estate, right? Similarly, off-market transactions. If you want to do off-market transaction, a particular farmer, let's say a particular farmer wants to sell his, stock of grains, let's say, right, or vegetables to another merchant, right, in advance. So it could be an off-market futures deal. So he may not be able to find a buyer. He may not be able to sell it, right? Similarly, there are certain types of bonds and debentures, debt instruments, where you may not be able to find buyers, right? There are not only sellers which are there. There may not be any buyers. Sometime back, this was experienced in a few schemes of Franklin Templeton, right? I'm sure many of you know about it, right? So yes, Poonamallee madam, fantastic, awesome, absolutely right, sir. Options and swap. Okay. Similarly, in case of collectibles like arts and antiques, right? So let's say you own sword of a particular king, right? So a particular king of 17th century, you have a particular antique item which belong to that king, and you think that it should be sold for minimum 5 crores, but you may not be able to find a buyer for that, right? So let's discuss fundamental analysis more, because see, let's accept it from a long-term investment perspective. Fundamental analysis, as we discussed, is from a long-term perspective, right? So this is what we should be discussing today. Okay. So now, before talking about it, let me give an example to you. Okay. Let's imagine that a particular family, they want to get their daughter married off, right? Now, let's say they are wanting an arranged marriage for their daughter. Now, you tell me, if let's say a family is looking for an arranged marriage, they are looking at alliance for their daughter, what are the factors they will look at? Please tell me. What are the factors they will look at? A family who is wanting to get their daughter married off, what are the factors they would look at to find, a good alliance? Okay, financial, right? So one would be the occupation of the groom, right? So the occupation of the groom, right? What does he do? Maybe they may want someone to be in a government job, civil servant, maybe an IIT engineer. In Tamil Nadu, I know people are very, in the southern part of the country, I know they are really keen that the groom should be an IIT engineer or an engineer, right? Please correct me if I'm wrong. Yeah, status, occupation, financial position, perfectly right, absolutely right, right? But maybe they also would look at the certain factors. For example, it could be caste. Maybe if the family is an younger Brahmin, they may want the groom to be an younger boy, possible, right? So they may look at the caste, or maybe the community. The person should should be from the same community. They may want that, right? And then they would also look at the family background. So the family should be decent. Family should should be such that They should feel happy getting associated with that family, isn't it? Right? So caste, community, family, right? That is one. And then the other thing would be occupation, which means about the groom itself, right? So groom's occupation, looks, right? Maybe they may want the boy to be more than 5 feet 10 inches, blah blah blah, isn't it? It should be well built, etc., etc. Right? He should not be obese. He should look athletic, right? That kind of could be there, right? So let's divide it to simply understand it in a simple manner. So the 3 parameters could be under which various things would come would be A, about the caste or the community, right? That's one parameter. The second one would be about the family, right? And the third one would be about the groom personal details. So looks, right? Build, etc., etc. 3 things, right? So first would family would look at it. Maybe first thing they would look at it. Second thing they would look at it. Maybe it's quite possible family will say, no, to us, we have a cosmopolitan culture. It does not matter which caste this person is of. But yes, we would want the family to be, right? And the third thing they would say that, okay, let's also look at the personal details of the group, right? Imagine now that instead of an arranged marriage, the girl has already, chosen, identified a boy, and now the girl is wanting approval from the family. So the girl is saying that he is the one whom I have chosen. Please approve. Now tell me, what is it that the family will look at first amongst all these 3 things? What is it that they are likely to be looking at now from the perspective of, suppose the girl has identified the boy already. Now, which one are they likely to look at? Okay, maybe caste community, maybe. But see, the girl has already chosen the boy, no? Character, yeah, character, yes, correct. So character again would pertain to the boy, the boy himself, no? The character of the boy. So now in this case, probably they would look at the groom's personal detail first, right? How does he look? Blah, 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 blah. Then they may look at the family, and then they may look at it. So earlier in arranged marriage, it was like this. First, second, third, this way. Now, in case of a love marriage, probably it would be first here, second here, and third here. It would be this way now. Yes? Okay. Do we agree on it? Yes or no? Do we agree with it? Yeah, fine. Okay. Okay. So now hopefully it will become easy for you to understand. Now, how do we pick up stocks? So imagine you have to build a portfolio now. You have to invest money in the stock market, right? You want to buy shares of certain companies. So which company would you own in terms of shares, right? Which company would you invest in? So we shall learn about EIC analysis, right? I will share with you what EIC is all about. So E stands for economy related to the economy, right? I stands for industry related, and C stands for company related, right? About the company itself. Just like we said about the groom himself, right? So the first is economy, then is the industry that it belongs to. For example, Hero Motors belongs to the two-wheeler industry, right? Maruti belongs to the car industry, correct? Hindustan Unilever belongs to the consumer goods industry, right? Fast-moving consumer goods industry. So this is what EIC is all about, right? So one is EIC analysis. The second one is the valuation, the quantitative factors as we discussed, right? The valuations and the multiples and the financial ratios of the company. Okay, so then we look at whether the stock is priced correctly or not, right? Now let's look at the EIC approach. Now there are two approaches here. The first one is called as top-down approach. Top-down approach, right? So top-down approach is that first you look at the factors pertaining to the economy, right? Economy-related factors. Then you look at the industry-related factors, and then you look at the company-related factors. So this is called as top-down approach. So you're moving from top to down. You're moving from E to I to C. Correct? The other one is called as bottom-up approach. So here first you look at the company, then you look at the industry, and then you look at the economy-related factors. Right? So these are two approaches which are there. We will look at it with example. Now let's imagine you follow a top-down approach, right? So what you do is you check out, okay, in the economy today, which are the sectors which would really be in demand going forward, right? So considering the way the world is moving, which are those sectors which would be in huge demand going forward? Please tell me. What are the kind of products or sectors where the future lies? Okay, fantastic. Medicine, pharma, very good. What else? Very good. Yes, what else? Manufacturing sector, okay, right? Food industry, education, technology, technology. Isn't it? For example, going forward, we'll need electric cars, right? The fossil fuel cars would be on its way out. We will need more and more electric cars, right? We are talking about renewable energy now. For example, maybe we would want to harness the solar energy. We would want to harness the wind industry, right? Wind power rather, right? So here you look at where does the future lie. Now you look at which are the industries which are likely to get benefited, right? For example, pharmaceutical industry. For example, automobile industry. For example, those companies which are producing batteries, right? So that is I. And then you find out within those industries which are the companies which would likely to get benefited where the future lies, right? So first in the economy, in case of a top-down approach, then industry, and then the company, right? But imagine somebody tells you that you should be buying the stock of XYZ company, whichever, right? Now you may be finding out about that company. First you find out about the company, then you find out which industry does it belong to, what is the future of the industry, right? Then you look at whether, considering the economy related growth, whether this industry has a great future or not. Right? Now you are following a bottom-up approach. Right? So just like that girl's love marriage case, first you look at the boy, right? And then you look at the family, and then maybe you look at the community, caste, etc., etc. Right? Here, first you look at the company, then the industry, and then the economy. That's the bottom-up approach. So economic, industry, and company factors. Top-down approach is economy, industry, company. Okay. Whereas bottom-up approach is first you look at the company, then you look at which industry does it belong to, and then you look at the economy. So let's look at some examples. So economy, what will you look at? GDP growth rate, which are sectors which are likely to do well in the economy. What's the inflation rate likely to be? How is the monsoon going to be like? If the monsoon is going to be good, hello, am I audible? Am I audible, please?
Yes, sir, you're audible.
Okay. I got this notification mentioning I've got signed out. So that's it. Then I thought I'll check. All right. Sorry for the inconvenience. Okay. So, for example, if the monsoon is likely to be good, the rural sector would get benefited, right? If the rural sector is likely to get benefited, all those industries which, are dependent upon the rural sector, for example, two-wheelers are likely to sell more. For example, mobile phones are likely to do well, right? Because rural sector is a big consumer for all these things. Again, coming to the company level, Mahindra and Mahindra is very strong in the rural sector. So if the monsoon is likely to be good, Mahindra and Mahindra will get benefited, right? Industry, you look at the nature of the industry, the life cycle, the specific policies of the government. For example, if the government policy is such that it is giving a boost to the manufacturing sector, then the manufacturing sector will get a boost, right? If manufacturing sector gets a boost, then those companies which are in the manufacturing sector, they will get benefited. And then the company related factors, right? So who is the management of the company? What has been the past, reputation of the company? What kind of innovation are they doing, etc. Right? Let's look at a case study. So a very short case study. Now, on December 31st, 2019, the government said that they are going to be investing 1,02,000 crore rupees in the infrastructure sector, right, over the next 5 years, right? So Ms. Nirmala Sitharaman, she announced that the government is going to be spending 102 lakh crores. So infrastructure is a big focus area for the government, right? Now imagine if the infrastructure sector is going to get benefited, which which are the industries within the infrastructure sector which will get benefited? Please mention which are the industries which are going to get benefited by boost to the infrastructure sector. If the government is going to be spending huge money in on infrastructure, automobiles, yes, right? Construction, electricity, yes, construction, right? There would be a lot of malls which will come up, correct? There would be a lot of engineering companies which will get benefited. Engineering industries will be doing well. A lot of bridges will get made. A lot of metros would come, blah, blah, blah. Right? Now we look at the companies within these industries which will get benefited. So L&T would do well. You're talking about infrastructure, sir. We're not talking about the pharma is not from infrastructure, no? So right now we're talking about this in infrastructure push, right? So construction, which companies are there? So you have L&T, for example. L&T would get benefited. A lot of companies which are into construction projects, they will get benefited. Maybe real estate companies will get benefited because a lot of malls will come up, right? Yeah, ABB, perfectly right. Okay, right. So that's just an example. Another example, the government, in 2014 announced that they will have 700 plus smart cities in the country, 750 odd smart cities in the country, right? Imagine if the focus is on smart cities, what industries would get benefited? Yeah, what industries would get benefited by this smart city project? What kind of industries would get benefited? For example, just imagine, yeah, travel and tourism will get benefited, definitely, perfectly right. Construction, absolutely right, right? When houses will get constructed, paints will be required. So people will require paints, people will require ceramics, right? People will require vitrified tiles, right? People will require cooking pipe gas, right? They would require pipe gas. So Mahanagar Gas Limited and Indraprastha Gas Limited will get benefited, right? They will require construction. Okay. So now we look at which are the companies which would get benefit, right? So that is how we work on it. Another example. So if let's say going forward we will have a lot of electric cars coming in. Okay. So which are the companies which will get benefited? So you have Amara Raja, you have Maruti Suzuki, you have IEX company which has recently come, that will be there. You have Excite, Power Grid, etc. Kalpataru transmission, right? Again, going forward, we will have focus on renewable energy, right? So which are the companies which will get benefited by it? So this is how we look at it, right? That's where the future lies, right? So if we are wanting to build a portfolio, we would build a portfolio from the perspective of the future. You know why China has been able to win so many gold medals in gymnastics and other sports? You know why? Any idea? I'm sure all of you would be knowing. So why is China been able to do so well in Olympics? They start training small kids. Yeah, they start, harnessing the potential of the small children itself in schools. Primary schools itself, they start training people. In fact, it is said that they train them so hard that actually they sort of torture those students, right? But their focus is that they want to groom them for bringing medals going forward, right? So if you want to build a portfolio of future, you need to focus on the future companies, right? That is what the entire concept is. Okay. Another example, see, going forward, we will have 5G technology, right? So which are the companies which are working on 5G technology? These are the companies which are working on 5G technology, right? Because that's where the future lies. So we will focus on just one. Okay, another example. Say in the month of December, the government announced that it is going to be giving production-linked incentives to manufacturing companies, right? The government said that we will not give you incentives straight away like this. We will link it to production. You increase the production, we will give you incentives, right? Now, whom will it benefit? Those companies which are in the manufacturing sector, they will get benefited because the government's policy is such, right? So which are the companies which will get directly or indirectly benefited by it? So these are the companies which would get directly, right? Manufacturing companies, ABB, Siemens, Thermax, right? Triveni Engineering, Honeywell, BHEL, they will get benefited directly. And these are the companies which will get benefited indirectly. So SBI, HDFC Bank, etc., etc. Because if these companies do well, where will they park their money? Where will they take loans from? They will take loans from banks, right? So if these companies do well, those companies will also do well, right? So it's a matter of logic. It's not that we will invest our money just because somebody is asking us to invest. We will apply logic. We will see whether it makes sense to put money here or not, right? Remember yesterday what we learned about? We learned about investment versus speculation, right? So investment is done with research by applying logic. Okay. So finance is logic. Now we talk about the quantitative factors, pure numbers, right? So why would you buy stock of a particular company? Because that company is likely to become profitable, because that company would be earning more and more profits. If that company earns profits, you may get dividends, plus the value of the stock, the market value will increase, right? Just like we saw the example of Rajat's restaurant. If the market value of the company increases, your stock price will increase, right? Simple. Okay. So every company creates 3 kinds of reports in its annual report, right? It focuses on 3 kinds of reports. It's not that during only annual report it is done. I mean, it is done every quarter, but I'm just saying that in an annual report of a company, there are 3 reports which are part of the final, the books of, which are those? One is profit and loss account, right? Which is income minus expenses, right? Whatever the company has earned, whatever it has spent, that would work out to, after deducting taxes, depreciation, etc., that would be net profit, right? The other one is balance sheet. The balance sheet is, as we learned in the first session, is the assets. It comprises of details of the liabilities of the company and the assets, right? Assets versus liabilities. And the third one is the cash flow statement, right? For example, say company may have done its business on credit, right? The company manufactures, let's say, sarees, but it has made sale. It has done the sale, but the money hasn't come in as yet, right? It gives credit to its customers, the shopkeepers. The money hasn't come in as yet, right? So ultimately, you also look at how much money has come. What's the cash flow available with the company, right? So two companies, imagine company A, company B, both doing the same business, both earning the same profit, right? Which one will be more valuable? The one which is more cash rich, right? because ultimately the cash is king, as we know, isn't it? Right. So let's look at the how does income statement get created. Okay. So very simply, first you have the income of the company. Where could the income be from? It could be from revenue, from the sales, right? The company could have other income also. It could have interest income also, right? So that would make the total income of the company. It is also known as the top line, right? The revenue is known as the top line, right? And then you have expenses. Where would the expenses get incurred out of? So whatever it is manufacturing, it would have raw material, right? So raw material would have certain cost. So the cost of goods sold, whatever goods have got sold, what did it cost the company to manufacture those goods, right? Then it will have administrative expenses, salaries of employees, blah, 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 marketing expenses, advertisement, promotion, etc., etc., right? It may have borrowed some money, so interest needs to be paid, so there would be interest expenses, right? Plus, it could be depreciation. For example, for software or anything which is intangible asset, there would be amortization. Okay, and then it's supposed to pay taxes also. So these would be the expenses of the company. Right? Now, if the company is profitable, it will create more assets. Right? If it creates more assets, it will have more income next year. If it has more income next year, it will create more assets next year. Right? This is how growth happens. But what if the company incurs loss? Then ultimately, if the loss is too much, then the shareholders will have to pump more money. Isn't it? Just imagine a particular student who gets a job, right? He loses his money. He bets in a particular, he goes to a casino and he spends money on a casino. He runs out of money. So then he will ask for money from the father, no? Father will have to fund more money. Parents will have to fund more money, right? Same the shareholders will have to do. Then again, if the company incurs losses, then more money, right? Liability, the company may have to borrow more and more money, right? So ultimately, it will not be able to do it, right? So income expense statement of a company very clearly helps you know as to what is the strength of the company, how much profit is it making, right? So it's based on the equation revenue minus expenses is equal to profit. If the expenses are more than the revenue, then there will be loss, right? So this is how the profit and loss actually looks like in a very simple manner, right? So the revenues, from the revenues, the cost of goods sold will be deducted, right? Now this is what is called as Ebitda. Just give me 1 minute. My pen has fallen down. I'll just take it. Just a minute. Sorry. The tablet pen, no, it fell down. All right. So see, from the revenue minus the cost of goods sold will give you the gross profit, right? Gross profit. And from the gross profit, after you deduct the general expenses, it is known as Ebitda. You would be hearing this term regularly, Ebitda, earnings before interest, taxes, depreciation, and amortization, right? So before you've deducted the taxes, interest, taxes, depreciation, and amortization, that's what is called as the operating profit, right? This is also known as the operating profit of the company, right? And then after you've deducted interest, so what is the importance of EBITDA? See, imagine there are two companies, right? One company has taken debt, it has taken loan, so it has to pay interest also, right? The other company does not have any loan on its books, in its books. It does not have any loan, right? Imagine the operating profit of both the companies is the same. Operating profit is the same, but one company does not have loans, so the EBITDA of that company would be higher, correct? The other company, I beg your pardon. The EBITDA levels would be the same for both the companies, right? But ultimately, the profit after tax would be different because one company has interest to pay, the other company does not have any interest to pay. The EBITDA levels will be the same, but the interest portion will be different, and that is why the net profit will be different, right? So the market also likes to see as to what is the EBITDA levels of the company, right? And when we calculate the return on capital employed, we'll check out later on. There we look at EBITDA very clearly, right? So we divide the EBIT by earning before interest and taxes. We divide that by the total capital of the company. Okay. So this is what liability is, right? The owner's capital, the long-term loan, the short-term loan, the bills payable, these are all liabilities. And then you have the assets of the company, right? Plant, machinery, inventory, receivables, blah, 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 right? Cash flow statement is again very important, the third thing. So in cash flow statement, you actually look at how much, so it has three parts again, right? The first part is how much cash are you generating from the main business, right? Let's say a particular manufacturing company, how much cash is actually coming from the main business? Let me give an example to you. Let's say there's a particular factory. Okay, so this factory is there and it is producing something. Let's say it's producing pens, for example. Okay, now whatever pens it produces, it sells those pens and it gets cash, right? So this would be cash from operating activities, right? Now just imagine they have got some excess capacity available in terms of the land, right? So what they do is that they give a portion of the land to a particular godown, right? Somebody else has a godown there, and this company also gets rent from them, right? They also get rent from them. Now that is also cash, but how much actually cash they are getting from the main business? Because you have invested in that company for the pens it is manufacturing, isn't it? So you would want to see a division between how much money are they getting from the main business and how much of other income that they have, right? Plus, second thing is how much money are they getting from investing activities and how much money are they getting from the financing activities. Maybe the company decides to, buy back its own shares. So it's buying back its own shares. That's a financing activity it is doing. Okay. So cash from operating activities, how much money is actually converted to cash from the main operating activity, right? Investing activity could be the company is selling off its, property. It may be having, it has scrapped a particular machinery and it gets money from that, right? Or it it could be from financing activities. So it may buy back its stock, right? Or it may issue dividends. So because the company is also the shareholder, companies, the shareholders are also the owners are also the shareholder, no? So when they get cash, obviously the company will be getting. Maybe the company has invested in some other company. Like for example, government gets cash from RBI. RBI pays a dividend to the government every year, right? LIC would be giving dividend to the government. So the government would be getting dividend from various public sector companies also, because it is the owner, right? Similarly, a particular company may have invested in other companies also and it gets dividend. Okay. So financial ratios would actually help us get complete information as to somebody has raised hand. Is it by mistake or you wanted to ask a question? You may park your question, please. Unfortunately, today we are going to be hard pressed for time, so we will take questions only towards the end. Okay. So financial ratios would actually help you evaluate the performance of the company, right? So you will look at various ratios in detail. So then what you do is, okay, by the way, when we look at the company factors, so EIC, we said that top-down approach, the last step is you look at the company, right? In a bottom-up approach, first you look at company, then you look at industry, then you look at economy, right? Now, whether you look at bottom-down, bottom-up, or whether you look at top-down, when you look at company, let's take an example. Let us say you are looking at the pharmaceutical industry, right? Now, in pharmaceutical industries, you have Cadila, you have Sun Pharma, you have, let's say, Biocon, you have Dr. Reddy's, right? You have multiple companies. Now, when you look at the financial ratios of a company, you compare the financial ratios of a company from another company within the same industry. You cannot compare the financial ratios of Sun Pharma with Maruti, right? You cannot compare the financial ratios of ITC with that of Hindustan Unilever, right? You have to look at the financial ratios of a particular, ITC and Hindustan Unilever. They, the FMCG sector would be there. You will not look at the financial ratios of ITC with Dr. Reddy's, right? You will look at it from the same industry. Yes, Hero Motors, if you are comparing, you have to compare it with Bajaj Auto, or you will compare it with TVS Motors, right? I hope it is clear. Okay. So what kind of financial ratios are there? So first one is liquidity ratio. So liquidity ratio means how much money does the company have to pay for its short-term liabilities, right? For example, in the case of individuals, whether the person has enough money to pay off the bills or not, right? See, we all would have to pay bills pertaining to kitchen, milk, right? Daily basis, we will be paying so many bills. Whether we have money available to pay the bills and EMIs, so that will also be our liabilities, right? Whether we have money to pay for our liabilities or not. Then leverage ratio. How much of loans does the company have? as compared to the assets. So in terms of the assets, right? In terms of the capital, in terms of the equity, I beg your pardon, it's the equity of a company, right? Equity of a company versus the debt of a company, right? So debt divided by equity. So equity, Rajat's example we learned yesterday. So in that example, we said that all the shareholders, they had put money in the company, right? There was not even zero, the company had zero debt. There was no debt in the company. All the money was put in by the shareholders, right? So that is what equity is about. But imagine a scenario if the paid up capital of the company, the owner's capital was 10 lakhs, right? If Rajat and his partners, they had taken loans of 15 lakhs, right? Then 15 divided by 10, 1.5 would have been the leverage ratio of the company. The debt would have been 1.5 times of the equity. But imagine a particular company where the debt is 3 times of the equity. That means that company is in a huge risk, right? The loan that the company has taken is really very high beyond the equity that it has. Okay, requesting everyone not to kindly, annotate on the screen, please. Okay. The other one is profitability ratio. So what is the profitability of the company? How is the growth in profits like, right? So for example, sorry, not growth in profits, in terms of the profit margins. Let's take an example. Let us say a particular company's total sale, right? Total sale of the company is 1 crore, but the net profit of the company is 10 lakhs, right? Which means the net profit ratio of the company is 10%. Right? But imagine if other companies in that industry, their net profit ratio is far better, then it means this company has not been doing very well. Right? So what is the profit ratio? Similarly, how efficient is the management? Right? How soon are they able to liquidate the inventory, whatever stocks they have? How soon are they able to generate cash? For example, those people who owe them money, right? All those people whom they have to recover money from, how soon is the company able to get money from them, right? And then the last but not the least one is the actual price of the share, right? The valuation of the share considering the earning per share, considering the book value of the company, considering the sales of the company, etc. Right? So these are the various ratios, right? Within the liquidity ratio, you have current ratio, you have asset test ratio. Now, the good thing is you don't have to remember all this. All this data is available on moneycontrol.com. There are multiple websites, right? You can get this data easily. You just need to understand the purpose why we have this, right? So that you can take informed decisions. You don't have to pass any exam remembering it, so don't worry about it. Okay. Similarly, leverage ratio, you have debt ratio, equity ratio, right? Debt to equity ratio, etc. Similarly, profitability ratio, you have gross margin ratio, net margin ratio, the gross, the total, how much is the gross profit as compared to the total sale, how much is the net profit as compared to total sales, right? Now, these 3 terms are very important. So, earning per share we learned yesterday. earning per share is total, profit, net profit divided by the number of shares outstanding. Correct? So if a particular company has a net profit of, let's say, 1 crore, if the net profit is 1 crore, right? And if the total number of shareholders are, let's say, outstanding shares are 10 lakhs, right? Then what is the earning per share? Please tell me, please write in the chat box. If the net profit of the company is 1 crore and the total number of outstanding shares are 10 lakhs, then what is the EPS? Yes, 10. Yes, Amrita madam, perfectly right, 10. It's 1 crore divided by 10 lakhs, right? Yes, correct. All right, fantastic. So that is the earning per share, right? Which means how much would be the due, profit for each against each share, right? How much is the profit per share? Okay, and then you have return on capital employed. So return on capital employed is the EBIT, earning before interest and taxes, right? Divided by the total capital. Total capital means equity plus debt, right? Similarly, return on equity is what is the total equity of the company, right? Divided by the so equity divided by the net profit. That's the ROE. So that is what you compare one company to the other one. You look at how regularly is the return on capital employed been growing. So suppose a company has been growing, in terms of return on capital employed at the rate of 20% every year, which means every year the return on capital employed is growing at the rate of 20%. Right? That's a very good sign. If a particular company is growing at even higher rate, then that's even a good sign, a better sign, right? Same is return on equity. So how strongly, how well is the company growing in terms of total equity base, right? Similarly, you have return on assets also. So what has been the return on total assets of the company? There are a lot of financial ratios. These are the important ones, right? And then how efficient is the management? So inventory turnover ratio. How soon is the company, in how many days is the company able to rotate the cash? So let's take an example. Let us say a particular sari shop, right? A particular sari shop has a stock of, let's say, 10 lakhs in his shop, right? And he is able to liquidate the entire stock in 1 month. Example, right? So the inventory turnover rate for that shop would be 1 month. Right? Now, if he is able to bring it down to 15 days or 20 days, then it means that he is able to generate cash faster, no? He'll be able to rotate his money faster. Same with the company. But if a company takes a much longer time to be able to sell off its inventory, then that's not a good sign. Right? Again, payables turnover ratio. So whatever the money company owes to its creditors, right? If let's say a particular company has negotiated good contracts with its vendors, and the company says that we will pay our vendors after 60 days, right? So the company is able to use that money in a better manner, no? But if a particular company, a particular company's payable period is 15 days, then that company may not get the advantage of using that money efficiently, right? Again, price earning ratio, price to book value ratio, price to cash flow ratio. The share price the share price divided by the EPS is PE ratio. We will discuss this in detail. Okay, this is important, right? Price to book value ratio, price to cash flow. So what is the share price divided by the cash flow which it is generating from operating activities, right? Price to sales ratio. How much is the ratio of the share price divided by the total sale it is making? And very important ratio, the enterprise value of the company divided by the Ebitda ratio. So these would help you work out, compare the performance between one company with the other one, right? All right, so let's go further and understand this concept of valuations. Now, so just got this message recording has stopped, just for your information. All right. All right. So, see, why are we buying a particular stock? Right? We are buying a particular stock because the company would be earning more profits going forward, right? And this company would be doing better in the future, right? Let's take an example. Let us say currently, just a minute. Currently, a particular company, the share price is 200 rupees, right? That's the price of the share, right? Now, imagine that the earning per share of this particular company is 10 rupees, right? That's the EPS, which means that the share is available 20 times of the EPS, right? You are asked to pay 20 times more than the current EPS it is generating. All right. Now imagine the company is expected to grow at the rate of 20% each year. Right? Now, as per the latest reports, 2001 annual report, the EPS is 10 rupees. Right? EPS is 10 rupees per share. Correct? But since the company is growing at 20% each year, in 2022, the EPS is expected to be 12 rupees. Why? Because the company is expected to grow at the rate of 20%. So rupees 10 EPS would grow to rupees 12, right? And in the year 2023, this EPS is likely to become 14.4 because it will grow by 20% more, right? So the EPS currently this year is 10 rupees. Next year, it is likely to become 12 rupees. Next year, it is likely to become 14.4 rupees, right? So FY23, the EPS is expected to be 14.4. Now, the market values a share from a future perspective, right? The market values a share from a future perspective, futuristic perspective, right? Now, imagine if the companies in that particular industry are trading at 20 times FY23 EPS, right? If the market is willing to pay 20 rupees of PE multiple, price earning multiple, for the share, considering the expected EPS in the year fiscal 22, which is 23, right? How much should this share be priced at? if you are likely to pay 20 times this EPS, what should be the right price of this share? Just share in the chat box. Yeah, please tell me. No answers? Simple. 14.4 multiplied by 20, right? So 14.4 multiplied by 20 is 288. 288, which means the market would be willing to pay 288 rupees for this share. So the price of this share should be 288. It is available at 200 rupees, which means you should be buying this share, right? It's a very theoretical example because currently it is available at 20 times the historical price, right? Historical price means the latest earning per share which is available, right? Whereas you should be valuing this share from a future perspective. Okay, so that is how we look at the PE ratio. Okay? Just consider this fact. Imagine in the year 2007, if somebody knew that this player would become a great player going forward, right? Would become captain of Indian team, any advertising agency would have signed up a long-term contract with this player, right? Obviously, at that time, he would have signed a contract even for 10,000 rupees, isn't it? Because obviously nobody knew him at that time, right? So that is how what you need to look at. You need to be able to find those winners, which will be really the future going forward, right? Imagine you buy a calf right now, right? Going forward, when that calf becomes a cow, obviously the price will really become huge. Right now, you may be able to buy the calf at a very less price, right? Okay, so these are the various valuation ratios that we use. Price to earning ratio is the market price divided by the EPS, right? So whatever the market price, price means market price divided by the earning per share. Price to book ratio is the market price of the share divided by its book value. Book value of the share means what is the current value that the shareholders will get, right? Considering the company gets liquidated, right? So it's actually the total shareholders equity which is there, right? Plus reserves and surplus minus the valuation. I don't want to make it complicated. Right now, just understand the total money which will come to the shareholders, which is the entire shareholders equity plus reserves and surplus divided by the number of shares outstanding, right? You don't have to remember all these things because it is available on various websites. Okay. Similarly, price to cash flow ratio. So suppose a company is generating a cash of let me write here. Suppose a company is generating cash flow of 50 lakhs, right? Divided by the total number of outstanding shares of 10 lakhs. 10 lakhs, which means what is the cash flow per share? It's 5 rupees, right? Now suppose this share is trading at 200 rupees, which means the price to cash flow ratio is 40, right? The share is trading at 40 times the cash flow which it is generating, right? Another company from the same industry, if it is available at 35 times the cash flow, then it shows that probably this share is more expensive, assuming that both companies are same, from other perspectives. Similarly, enterprise value to EBITDA ratio, right? The lower it is, the better it is, right? So what is the enterprise value of the company? So all these are valuation ratio. And another one, price to sales ratio. So if a company is making losses because it does not have any EPS, EPS will be negative. It's not making profits, right? In that case, you look at the price to sales ratio. By the way, the Zomato IPO came recently. The price to, because it was loss-making company, the price to sales ratio was 29 times. And by the way, just for your information, Hindustan Unilever trades at 12 times the sales it is generating, right? ITC is trading at 5 times the sales it is generating. Zomato IPO at 76 rupees was 29 times the sales it generated. Now, because it is trading at around, I don't know what today the value is, but let's say if it was 130 rupees, then it's way beyond 50 rupees per price. The price to sales is more than 50 rupees. Crazy valuation, absolutely. Okay. So that's what we discussed. From a future perspective, forward earnings, how much are the investors willing to pay? Right? So what is it that the price divided by earning per share is expected? So this is a very, very important number. So earning per share, as we know, is total profit divided by the number of shares outstanding. And we look at the future perspective. How much is the EPS likely to grow by? Right? That would be the growth rate of the company. Okay. So we compare two companies from the same sector and then evaluate. Let's take an example. A company is trading at 20 times its FY20 earnings, but it is still 16 times, let's say, FY23 earnings. Just read it as 23 instead of 21. Okay, but it is still trading at 16 times from a future perspective, right? Market is willing to pay 20 times, which means it is underpriced, right? Which means it should be bought right now. There is substantial potential for long-term growth here. So you don't look at it from a historical perspective, you look at it at a future perspective. Right? So this is what the current situation is. The market is at around 26.7 levels as of now, as of yesterday evening. Right? The price to equity ratio, price to EPS ratio, PE ratio, till yesterday in case of Nifty was 26.7 times. Right? Historically, we have traded at a lesser level. But the market is willing to pay this because considering the fact that people have got vaccinated now, the pace of vaccination is growing. There is going to be a lot of growth which is expected going forward, right? A lot of companies are coming in India now because companies are not willing to do much business with China. India is likely to grow at a much faster pace, right? So market is expecting that future earnings would be much higher, right? So from a historical perspective, so this is from a historical perspective, right? It appears to be high, but the market believes that the future earnings would be much higher, right? So they believe that as of now, the market is not at a high level. Another thing, important thing is the book value, as we discussed. Book value is how much money will come to you. So price to book value is what is the price in comparison to the book value of the company, right? Now, this particular ratio is important from a bank's perspective. So when you compare two banks, no, so that is when you should also look at the price to book value ratio. Because see, whatever business the bank, whatever money the bank gets, for the bank, it is a liability. You, me, whatever money we are putting in the bank is actually a liability for the bank, right? Loan assets for the bank are those loans which it is giving to the market. From a bank's perspective, it is the other way around, right? So whatever loans the bank is giving, that is asset for them. But whatever money you, me, and other people are giving to the bank, that is liability for them, right? So from a bank's perspective, this could be compared between two banks. Price to book value ratio. Okay. Price to sales we've already discussed. So it is how much is the price in comparison to the total sales divided by the number of shares outstanding, right? So in comparison to the price which you are paying per share, how much is the sale per share of the company, right? So this is specially used when the company is making losses, like I gave you the example of Zomato, right? When the company is making losses. Similarly, another thing as we discussed is cash flow, very important, right? How much cash is the company actually generating? So assume two companies have the same net profit, but one company is generating more cash from its operating activity. That company would be, people would be willing to pay a higher share price for that company. So many people, they also look at the price to cash flow ratio along with the PE ratio, right? So as to be able to take a more robust decision, because at the end of the day, it's quite possible that the company is doing business on credit, right? It has not received money as yet. So they would also look at how much money has the company actually also received in terms of cash. Okay, another important thing is the dividend yield. So as we learned yesterday that the company, also distributes dividends. Okay, so dividend yield, very simply speaking, is the dividend declared, right, divided by the price of the share. So let's take an example. Let us say a company declares a dividend of 2 rupees per share, right? And the price per share of that particular company is, let's say, 100 rupees, right? So what's the dividend yield? It's 2%. Okay. Another company may declare a dividend of 2 rupees, but let's say its share is currently trading at, let's say, 160 rupees. Okay. So in that case, the dividend yield will be 2 divided by 160 into 100, right? So 1.25, whatever. So that would be the dividend yield. Okay. Another company, let's say it gives a dividend of 3 rupees, right? And let's say it's currently the share is trading at 150 rupees, theoretically speaking. Okay. In that case, the dividend dividend yield will be 2%. Okay. So it's the dividend declared per dividend value declared per share divided by the market price of the share, right? By the way, if a company declares a dividend of 10 rupees, right? let me ask that question again. A company says that we are declaring 100% dividend. A company announces that it is declaring 100% dividend for the shareholders, right? The face value of the company, face value per share of the company is 10 rupees, right? What would be the dividend per share? Company says that we are declaring 100% dividend. The face value per share is 10 rupees. What would be the dividend value? Yes, 10 rupees. Perfectly right. Perfectly right. Awesome. Somebody did not have the name. There was some, I think, mobile alphabets were there. Anyways, remember the percentage is based on the face value of the share, right? So if the company's face value is, if the face value per share is 1 rupee, if the face value per share is 1 rupee, right? And the company says that we are declaring 1000% dividend. The company says that we are declaring 1000% dividend. Then this means that the company would be declaring dividend of 10 rupees. Right? Because 1000% means 10 times, right? So 10 times of the face value is 10 rupees. Okay. So the dividend is always on the face value of the company. Investors prefer, let's say, apple to apple comparison. They would prefer those companies which have got low PE ratio, low price to book value ratio, and high dividend yield. However, it is quite possible that a company may have a low dividend yield because, as we discussed, it is wanting to plow back its profits into building reserves and surplus, right? Generally, you will see that the PSU companies, public sector undertakings, they will have a high dividend yield. Why? Because they have to pay to the government, no? The government wants money. So the government would be wanting them to pay high dividend, right? But the private sector companies, they may not pay entire profits as dividend. They would want to build reserves and surplus. So it is not necessary that there are two companies. If there are two companies, any company which has got a higher dividend yield is a better stock, right? It depends. I mean, you need to look at the other parameters also. Okay. Again, when you are in a bull run, when the stock prices are booming, right? Then in that case, because the price would be high, the denominator would be high, the dividend yield would appear to be lower. But in a bear run, when the prices of shares would go down, in that case, because the denominator would be low, market price would be low, the dividend yield will appear to be higher. Right? Yeah. Okay, so just a comparison. These are the companies which are paying high dividend yield, right? So comparison between growth stocks and high dividend stocks, right? So Power Finance Corporation, Indian Oil, Hindustan Petroleum, ONGC, Petronet, NTPC, Mineral Development Corporation, Bharat Petroleum, Coal India. These are high dividend companies, high dividend yield companies, right? But Asian Paints, Havells, HCL, all these companies, HDFC Life, these companies, these are high growth stocks, right? There are certain stocks which are high growth also, high dividend also, as per the past track record. So Hindustan Unilever, Colgate-Palmolive, Nestle, Hero Motors, Godrej, Bajaj, Torrent, Marico, Britannia, they lie, in both the segments. Okay. All right. Now, what is concept of moat? Very important concept. See, in olden days, when there used to be kings and castles and all that, the kings used to build their castle in such a manner that they had water around it, they had some, uh, uh, ditch around it. The whole objective was to make sure that the enemy could not attack it, right? So this is what a moat actually is. The moat means that you have some competitive advantage. I'm sure you would be knowing that, they used to build their forts at a hilly area. The whole objective was so that the enemy would have difficulty in climbing, right? Moreover, from a top, it's easier to attack the enemy down than, for the enemy to attack you at the top, right? So that itself is a moat. Now, what does it mean from a company perspective? Okay, from company's perspective, moat means having some competitive advantage. Having some competitive advantage which others do not have. For example, from a college perspective, what could be the moat? The moat could be that you have been in existence for more than 40 more than 40 years. You have an alumni which is which has so many IIT engineers, so many NRIs, so many people, and who's who of the society. You have various film stars, you have various politicians who have been students of your college, right? It could mean that your faculty, your college boasts of faculty members who have got international experience also, right? There's a legacy, there's unique advantage, which means no others will not be able to copy that advantage very soon. It will take them years to be able to come near you, right? So that's a moat which is there, right? Now, if we invest our money in those companies which have moat, then obviously it means that we will have advantage. So what are the companies in India with moat? So Tata Consultancy Services, right? SBI, Asian Paints, wide distribution network, great brand, reputation, great brand equity, uh, quality, market share, etc., etc., right? So it's like they have built a fortress at a height, which is, it's very difficult to attack, right? Pidilite, Fevicol company, we all know, right? Titan, huge brand, brand reputation, right? So they have huge advantage. So moat was the concept which was actually introduced by Mr. Warren Buffett, right? So Mr. Warren Buffett had been talking about it a lot. Again, you look at companies with almost monopoly, in their business. IRCTC, Hindustan Aeronautics Limited, Indian Energy Exchange, Coal India Limited, ITC, right? These companies have their own moat which is there. It is very difficult to get near them. Again, there are certain companies which have been able to reduce their debt phenomenally. So they have been able to pay off their debt, right? So now their balance sheet is much more lighter, right? Much more stronger rather. The liabilities, the loans have reduced, right? So which means they'll have to pay less of interest. The burden would be less. Okay? So that's an advantage for them. So these are the things we need to look at when we invest. Again, those companies, which have virtually nil debt, right? So these companies are the ones which virtually do not have any debt on their books, right? So obviously they have their own advantage, right? Now, how do we get various information from? For example, how do we get to know what is the management thinking about a particular company? What is the vision of the management? What does the management think this company will grow at the rate of? Where is the company investing its money, etc., etc. So this we get to know from the annual report of the company, right? So today, every company on its website would be having their annual report. It is also available from moneycontrol.com, from Stockage, and various other websites. So we also need to look at that. The more we read about a company, the better it is. It will help us to make informed decisions. Right? So fundamental analysis is all about qualitative analysis, quantitative analysis. For example, when you look at director's report, you get to know as to what is the company thinking about it, what is the future of the company. See, again, let's come back to the same example of a marriage, right? So before the alliance gets fixed, the groom's family and the bride's family, they will get along with each other. They'll talk to each other. You will get to know the views of the parents of the groom. Let's say you are the bride's parents, right? You would want to know what does the groom's mother think, what does the groom's father think. If you get this feeling that they are very greedy people, right? They are talking about car, they are talking about this much money to be spent on marriage, blah blah blah. You will get this feeling that they are very greedy people, right? Even if, let's say, assuming that they were a very good family, you may say, no, just because they are greedy people, we would not want to send our daughter to that home, isn't it? But suppose they are from slightly lower income background, but you get this feeling that they are visionary people, they are very nice people, they have got great thoughts, they have a lot of respect for your family, right? You see that the way they treat their servants also is very nice. They treat people with respect, right? uh, then you will say, fine, even if the boy does not have very high income, we would definitely want consider other things, because they are such nice people, they are so good people, isn't it? Same way, when you look at the management, you listen to the views of the management, you will get to know so many things. Okay, so qualitative and both quantitative factors you will look. The business model, corporate culture, all these things. Similarly, here you will look at the financial ratios, what kind of debt equity ratio they have, blah blah. So again, same thing. Quantitative factors would mean the ratios which are there, right? So we discussed about the EIC analysis. We discussed about various financial ratios, right? So these are the statements which we learned about: income statement, balance sheet, cash flow statement, right? We also learned about various kinds of financial ratios. Okay. So in nutshell, what we said was that we need to look at equity from a long-term perspective, right? From if we are looking at fundamental analysis, technical analysis would be from a short-term perspective, right? We need to take informed decisions. The valuations are supreme, okay? And we can differentiate gems from ordinary stones. The whole objective of fundamental analysis is that you need to find out, you need to locate the gems. You should be able to separate the gems from ordinary stones, right? You would be willing to pay a higher price for gems, isn't it? But you would not want to pay a higher price for the ordinary stones. Okay? So this is what we learned about. Now, if you could give me 5 minutes more, I would want to show you a tool which would really help you take decisions pertaining to stock very, very easily. Can I have your permission to take 5-7 minutes more, please? Can I take 5-7 more minutes, please?
Yes, sir. Yes, sir. Please,
sir,
sir.
please,
Yes.
sir.
Yes.
Okay,
Yes.
okay, thank you. Thank you. I want to show you a tool, and this tool would really help you, be able to take informed decision. Just a minute, please. All right, just a minute. Okay, this is a website, screener.in. Okay, I'll just I'll just connect, and then I'll just share the screen, and then I'll connect. Okay, so I hope you can see the portal, the browser. So just go to screener.in, screener.in, right? Okay. Now, what you do is, here you can follow certain companies, right? Suppose there are certain companies you want to follow because you think that there is great potential in that company. Can you name any company? Can you give me a name of any company which you would want to follow? Any one company, please? Can you name any company? Yeah. Any stock, please? Dr. Reddy's. Okay, fine. So let's say you write Dr. Reddy's. Okay. Now, these are the details you will get about Dr. Reddy's. Now, what you can do is you can follow this company. Okay. Now, there are hereafter, whatever developments happen with this company, right? Whatever is happening with this company, you will regularly get this information about this company. It would be available on your homepage in screener.in. Okay. Now, what you can also do is you can create screens. And I'll tell you what screens do. So we learned about financial ratios, right? Now, suppose you want to identify those companies which have been growing at the rate of 20%, right? So let's say I say that return on capital employed, right? Return on capital employed 5 years, last 5 years return on capital employed should be more than 20%, right? Should be more than 20. You don't need to write percentage. It means automatically more than 20%, right? More than 20. And, right, you say that return on equity, 5 years growth, more than 20, and, right, market capitalization more than 1,000 crore, right? So those companies, just for example, who have been growing with the return on capital employed growing at more than 20%, where the return on equity has been growing at the rate of 20% for the last 5 years, and the market capitalization is more than 1,000, right? So you run this query. Okay. There's a mistake, sorry. Yeah, sorry, I made a mistake. Okay. Now you run this query. I'll try again. Just give me 1 minute. In fact, I had already identified a particular thing. So it will be there. Just a minute. Let me show it to you. Screen created by you. So I had identified, those companies yesterday using this particular query. Sales growth of the last 5 years more than 15%, right? Average return on equity 5 years more than 20. Average return on capital employed 5 years more than 20. And market cap to, okay, I'll tell you the mistake which happened. I forgot to put and after every sentence. So that was the reason. In the previous one, I had not put and. So that was the reason why it was not coming. Okay. Every line you need to put and. Market cap to sales of more than 5, right? Which means that price to sales ratio that we were talking about, price to sales ratio was, less than 5. It should not have been more than 5. And market capitalization of more than, I had written 5,000, but let's identify 1,000 for a minute, right? So let's run this query. Now you get all these companies. It's like saying that you are identifying a boy for your girl who has to be, less than 28 years old, or let's say, 28 years old, who earns, 2 lakh rupees per month, who is an IIT engineer, blah, 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 blah. So you mention the all these things in the query, and you will get a list of all eligible bachelors, right? Here you get all these names of companies which have been growing at a very fast pace. Now you can, so look at the return on capital employed growth. They've been growing at a rapid pace, right? And there are so many results which are there. Now that's the reason to make it more restricted. Let's say you say that the market cap should be, more than 5,000. Okay. So you run this query. Now you get these names: Sonata Software, Supreme Industries, Gujarat State Petronet, Dixon. All these names you get, right? So this way you can mention what criteria. You don't need to calculate the ratios yourself. Everything would be available, right? So you mention whatever query you want to create. So I hope this will help you. This will help you. Similarly, you can also say, in case you want companies from certain industries, you can say which are the companies which have zero debt, right? You may mention with that also. Just a minute. Let's say we say that debt anyways, so this is how you can do it. You can work it out in a different manner, and you will get the results. You can run the query and you can work it in a different manner. Right? This way you can get different results. Okay. Did it make any sense, please? Will it help? Okay, Tata Motors, we go to Tata Motors, right? You get results about Tata Motors. So this way you can start following Tata Motors also. So now, whenever you log into the screen, right? Whenever you log into the company, you will get results about Tata Motors and whichever company you're following. So this is the best way you can start, shortlisting the names of companies considering this. So you look at various parameters and you shortlist companies. from this perspective. And that is a very good way of being able to really focus on. So here we are following the bottom up approach, right? So we are first looking at the company, then we will look at industry. When we are following a particular company, we are looking at a company, we are looking at an industry, etc. Right? Same way, what you can also do is you can look at first economy, which are the sector which are doing well, and then you can start comparing companies from different industries, right? So this way it will be top down. Okay, I'll just close the screen now. Okay, so this is what we discussed today: technical and fundamental analysis, profit and loss, balance sheet, and concept of valuation. And we also learned about the concept of moat. Yeah, I'll be happy to answer any question that you have. And I'm sorry for taking more time, but then this concept is this particular topic is relatively more detailed one, so that's why it took little more time. I'll just a minute. I'll just copy this one. All right. Any questions, please? So the quiz is there with you. Yes, madam. I'll share my contact details. So these are my contact details. So this is my number, and you can also follow us on Instagram, Facebook, Twitter. My LinkedIn ID is also Ravindra Singh Chawla. You can we can get connected over LinkedIn also. Any questions, please? Pleasure, madam. Thank you. I have attempted to simplify it. Hope you found it useful, because this is a little sort of complicated topic, and the time that we have is limited. So we cannot spend too much of time on this also. Thank you. Any questions, please? Anything you may not have understood, or you may want me to explain again? No question? Okay. So technical analysis is more about using the charts and the patterns to analyze the trend, and then to work out and then to predict the stock price, right? So you try to predict the stock price looking at the trends, right? It's about probability. But fundamental analysis is you are looking at the intrinsic worth of a stock, and then you try to look at the performance both qualitatively and quantitatively, and then you identify whether it is worth it or not, right? I am sure you would have been to a jeweler, and I'm sure you would have seen jeweler earlier days. At that time, there were no caratometers, or those machines were not there. So whenever, let's say, if somebody wanted to sell off the jewelry, right? Let's say you wanted to sell off some jewelry to the jeweler. What did he used to do? I mean, many years back, they used to put some, big magnifying glass in their eye, right? And they used to try and assess the piece of jewelry, isn't it? Your fundamental analysis is like that. right? So it's about uh, um, so the session on that technical and that is just 1 hour, just a 1 hour session for the students, and it could be across the different streams of students, whether from science background or commerce or anything. And I've already done about 15 odd sessions over the last 2 months. I mean, trust me, students find it very, very happy, because today's younger generation is much more keen to do trading for short-term profits than adults. Uh, these children are these kids today are quite innovative, and they believe in experimenting with a lot of. Okay, any more questions, please? Sorry, I got digressed. Any more questions? Yeah, so you may kindly send me a mail, I'll mail back, or you may text me your mail ID. I'll send a mail on this particular program. So that would help you to take approval and all that. All right. If there are no more questions,
No more questions. Yes, sir.
thank you very much.
Thank you, sir. Thank you very much,
Pleasure.
sir.
Pleasure.
You have inundated us with so much of information. And I would like to quote here Cicero, the Roman philosopher, who said, "A thankful heart is not only the greatest virtue, but the parent of all other virtues." As the saying goes, we would like to extend our warmest thanks to you, sir, for spending your most valuable time and sharing your great knowledge with us, sir. And now I would like to invite our professor, Dr. G. Purushottaman, Associate Professor and Head, Department of Commerce, Accounting and Finance, to give the formal vote of thanks. Sir, over to you.
Yes, thank you, ma'am. A very good afternoon to one and all present here. It is a great honor and a privilege to be called upon to propose a vote of thanks. We are extremely grateful to our chief guest, Mr. Ravinder Singh Chawla, founder and managing partner, RSC Skill Building and Consulting Solutions, to have accepted our request to join with us today, that means day 3, for our 7-day online faculty development program on cognitive analysis in financial services. Thank you. Thank you, sir. For this overwhelming success, I should thank Mr. P. Venkatesh Raja, correspondent, Dr. Sai Satyavadi, director, Dr. Maladi Silvakumar, principal, and Dr. S. Ganapathy, program coordinator, for leading us from front in making arrangement for this auspicious occasion. I thank faculty members for their support and the technicians for the Zoom app arrangements, and I express my deep sense of gratitude to all the participants who have actively participated in this section. Once again, I would like to thank all guests, staff, and all our students and participants. Thank you. Thank you so much.
Thank you, sir, for your kind words. Now I would like to thank all the participants who have attended this session. And please don't forget to attend the quiz before 5 p.m. Thank you, sir. And I thank everyone, and see you all tomorrow. Stay safe and have a great evening. Thank you, sir.
Thank you.